Today is Saturday, February 7th, 2026, and the silver market just gave us a signal that veteran analysts have been waiting decades to see. Right now, silver is trading at $76.89. Gold sits at $4,966.20. And Michael Oliver, a market analyst whose technical work correctly identified the 1987 market crash before it happened, has just issued targets so extreme they're forcing even skeptical investors to pay attention. His minimum projection, $500 per ounce for silver. His timeline? This summer, as in 4 to 5 months from today. But what makes this forecast different from typical market predictions is the framework behind it. Oliver doesn't analyze price charts the way conventional traders do. He doesn't chase headlines or follow sentiment surveys. His momentum structural analysis examines the underlying architecture of market movements, identifying transformations that unfold over years before most investors even notice. And according to his latest analysis, silver has just completed what he calls a rebirth following the recent price correction. The structural foundation that was being built through volatility is now locked in place. What comes next, he argues, is a move so powerful it will redefine how investors think about precious metals. In the next several minutes, I'm going to walk you through exactly what Oliver is seeing in his momentum indicators, why he believes this correction actually strengthened silver's trajectory rather than weakening it, and what his analysis reveals about gold's path toward $8,000 per ounce. More importantly, I'll show you why he thinks the opportunity window for positioning is measured in weeks, not months. Let's begin with what just happened in the silver market and why it matters more than the price action suggests. Between late January and early February, silver experienced a violent correction. From peak to trough, the metal fell approximately 18% in just days. Retail investors panicked, social media filled with claims that the rally was finished. Traditional technical analysts pointed to overbought indicators as proof that silver had gone too far too fast. Michael Oliver saw something completely different. In his framework, corrections during major structural bull markets serve a specific function. They don't signal weakness. They create what he describes as structural reinforcement. Think of it like a building under construction. Before you can add additional floors, you need to pour a stronger foundation. The recent sell-off, according to Oliver's analysis, was that foundation building process. Here's the critical distinction. During typical cyclical rallies, corrections lead to prolonged consolidation periods. Markets drift sideways for months, while participants debate whether the uptrend is intact. Momentum indicators deteriorate. The recovery, if it comes, lacks conviction. That's not what happened with silver. Oliver's momentum structural indicators show that silver's underlying force remained intact throughout the entire correction. The price fell, yes, but the market's internal architecture never broke down. Within days, silver began recovering lost ground. The snapback wasn't gradual. It was immediate and powerful. This behavior reveals who the dominant buyers are and what their intentions are. Short-term speculators exit during corrections. They're the ones who drive prices down sharply when volatility strikes. But structural buyers, the industrial manufacturers who need physical metal, and the institutional investors building long-term positions view these drops as entry opportunities. When these structural buyers absorb selling pressure within days instead of months, it tells you the market's character has fundamentally changed. Oliver describes what we are witnessing now as silver entering a new reality where old trading patterns no longer apply. The correction didn't damage silver's trajectory, it validated it. And if his momentum indicators are correct, the acceleration phase that follows this type of structural reinforcement is where the most dramatic price gains occur. To understand why Oliver's target seems so extreme, you need to understand how his analytical framework differs from conventional technical analysis. Most traders look at price charts and try to identify support levels, resistance zones, and trend channels. They use indicators like moving averages and relative strength indexes to determine whether an asset is overbought or oversold. When these indicators flash warning signals, they reduce positions or exit entirely. Oliver argues this approach is fundamentally flawed during structural market transformations. He uses an analogy. Watching price is like watching your car's speedometer. It tells you how fast you're currently going, but it reveals nothing about the engine's power or whether you're about to accelerate or decelerate. Momentum structural analysis, in contrast, examines the engine itself. His system measures the underlying force driving price movements across multiple timeframes. When momentum begins building in a market that has been structurally suppressed for decades, the indicators show a pattern he's seen repeatedly before major bull market explosions. He saw it in copper before its massive run in the 2000s. He saw it in lead before its 18-month tripling. And he's seeing it now in silver, but with readings that suggest a move larger than either of those precedents. According to Oliver, silver's momentum structure has broken through resistance levels that have contained the metal for over 40 years. This isn't a minor technical breakout that might reverse in a few weeks. This is a multi-decade ceiling being shattered. And when that happens, the price doesn't simply drift higher. It gaps violently upward to reach levels it should have hit years ago if not for artificial suppression. He calls this phenomenon lightning form repricing. Decades of pent-up pressure releasing in compressed time. It's not gradual, it's not orderly, it's explosive. And according to his current momentum readings, we're in the early acceleration phase right now. The move hasn't even approached its most parabolic stage yet. One of the most powerful dynamics supporting Oliver's forecast is the relationship between gold and silver, measured through what analysts call the gold-silver ratio. This ratio simply tells you how many ounces of silver are required to buy 1 ounce of gold. With gold at $4,966 and silver at $76.89, that ratio currently sits near 65 to 1. Historically, this ratio averages around 50 to 1 over extended periods. But during precious metals, bull markets, something remarkable happens. The ratio doesn't just drift toward its average. It crashes dramatically, sometimes falling to 30 to 1, 20 to 1, or even lower during mania phases. Why does this matter? Because it reveals silver's leverage compared to gold. Silver is a far smaller market than gold in terms of total value. When capital flows into precious metals, silver's price must move much more dramatically to absorb those flows. It's basic mathematics applied to market capitalization differences. Oliver's technical work shows that a critical resistance level in silver's performance relative to gold has been breached. The same pattern appeared before the 1979 to 80 explosion, when silver rose nearly 5 times in 5 months. It appeared again before the 2010 to 11 rally, when silver more than doubled in 7 months. Now it's happened a third time. But according to Oliver, the structural base supporting this breakout is wider and stronger than either of those historical precedents, suggesting the potential for an even larger percentage move. Let's run the mathematics on what this means for price targets. If gold reaches $8,000, which would match historical bull market multiples from its base, and the gold-silver ratio compresses to 20 to 1, as it did in 1980, silver would trade at $400 per ounce. Even with more conservative assumptions, if gold hits $6,000 and the ratio drops to 30 to 1, silver reaches $200. Oliver's minimum target of $500 implies either an even higher gold price, a more extreme ratio compression, or both occurring simultaneously. These aren't random numbers pulled from imagination. They're mathematical projections based on momentum readings, historical precedent, and market structure analysis. The real question isn't whether such moves are possible. History proves they are. The question is whether the structural conditions exist right now to support them. And Oliver's answer, based on 40 years of analyzing commodity cycles, is unequivocal. Yes. While silver's technical structure is compelling, there's an equally powerful fundamental story unfolding that most investors are completely missing. For at least 5 consecutive years, global silver consumption has exceeded production. We're running a structural deficit of approximately 200 million ounces every single year. And this gap is widening, not closing. Why? 2 reasons, and both are accelerating. First, industrial demand is exploding in sectors where silver is irreplaceable. Solar panel manufacturing requires silver's unique conductive properties. With global solar installation capacity expanding at unprecedented rates, particularly in China, which produces 80 to 90% of the world's panels, this single sector is consuming massive quantities. Artificial intelligence infrastructure is driving construction of enormous data centers. These facilities require sophisticated electrical systems where silver plays a critical role in connections, switches, and thermal management. The AI revolution isn't slowing down, it's accelerating. And every new data center being built increases structural silver demand. Electric vehicle production uses significantly more silver than traditional internal combustion vehicles. As global automotive fleets electrify, this demand vector continues climbing. It's not cyclical demand that disappears during recessions. It's structural demand that persists regardless of economic conditions. Medical devices, advanced electronics, smartphones all require silver. This is non-discretionary industrial consumption that cannot be easily substituted. Second, supply cannot respond quickly enough to meet this demand surge. Mining isn't like turning on a faucet. Discovering a new silver deposit, securing environmental permits, raising capital, building infrastructure, and bringing a mine into production requires a decade or more. Years of suppressed silver prices discourage the massive capital investment needed for new mining projects. Existing operations are depleting their highest grade ore bodies. Recycling, while helpful, cannot bridge a 200 million ounce annual deficit. This is the setup for what Oliver describes as lightning form repricing. When markets ignore fundamental deficits for extended periods, the eventual price adjustment doesn't happen gradually. It happens violently and rapidly as price catches up to where it should have been all along. The deficit was building quietly while silver traded in the 20s and 30s. Now, with silver above $70, the deficit still exists. The market is only beginning to price in the reality of structural scarcity. Let me give you some concrete evidence from just the past few days that validates what Oliver's momentum analysis is indicating. On February 3rd, silver was trading at $93.50. Within 72 hours, it had fallen to $76.89. That's a drop of nearly $17 in 3 days, roughly 18%. Traditional technical analysts immediately declared the rally broken. Social media commentary turned bearish. Yet by February 6th, silver had already begun its recovery. More importantly, the speed and strength of that recovery tells us everything about market structure. In a normal cyclical correction, you'd see hesitant buying. Prices would grind higher slowly over weeks. Volume would be uncertain. Instead, silver's bounce was immediate and forceful. This indicates strong hands. The institutional and industrial buyers stepped in aggressively at lower levels. They weren't waiting to see if the correction would deepen. They were treating the sell-off as an opportunity that wouldn't last. That's the behavior you see when sophisticated market participants understand the fundamental deficit we just discussed and recognize that current prices, even at $76, remain far below where equilibrium should be. Oliver's momentum indicators captured this dynamic in real time. While price was falling, his structural measurements showed the underlying bullish architecture holding firm. Within days of the bottom, those same indicators signaled the acceleration phase was resuming. This is precisely why his methodology focuses on momentum structure rather than price action. Price can be volatile and deceptive. Momentum reveals the true force driving the market. Now let's talk about gold, because Oliver's analysis doesn't stop with silver. His momentum work on gold shows a similar structural breakout occurring, though gold's trajectory differs in important ways. Gold has been in a steady uptrend for years, but it's been measured and controlled. Central banks have been accumulating. Institutional investors have been building positions. Retail participation has been relatively modest compared to previous bull markets. According to Oliver's framework, gold is now entering a phase where the move accelerates beyond what most analysts expect. His indicators suggest gold is heading toward $8,000 per ounce, possibly higher. What's driving this? Multiple factors converging simultaneously. Global debt levels are at historic extremes. Governments continue running massive fiscal deficits. Central banks, after years of tightening, are beginning to pivot back toward easier monetary policy as economic growth weakens. The purchasing power of fiat currencies continues eroding. Geopolitical tensions remain elevated. Institutional investors who ignored gold for years during the long bull market in stocks are now reassessing their allocations. Gold's role as a monetary metal, a store of value that exists outside the banking system, is being rediscovered by a new generation of investors who witnessed the financial instability of recent years. But here's the critical point Oliver emphasizes. While gold's move will be significant, silver's move will be exponentially larger in percentage terms because of the ratio dynamics we discussed earlier. If gold goes from $5,000 to $8,000, that's a 60% gain. Impressive by any standard for a monetary metal. But if silver goes from $77 to $400, or even to Oliver's $500 target, that's a 400% to 550% gain. This is why silver is often called gold on steroids during precious metals bull markets. The smaller market size and the industrial demand component create explosive upside leverage. Oliver's analysis suggests both metals are in the early stages of moves that will rewrite investor expectations, but the asymmetric opportunity lies in silver. Let's address the elephant in the room. Can these targets actually be achieved, or is this just speculative fantasy? The skeptics will point out that $500 silver sounds absurd. In 1980, silver briefly touched $50, and that remains the nominal all-time high for most of the past 4 decades. How can anyone seriously project $500? Here's what the skeptics miss. First, inflation-adjusted analysis. That 1980 peak of $50, when adjusted for monetary inflation over the past 45 years, equates to approximately $185 in today's dollars. So silver reaching $500 wouldn't be 10 times the historic high. It would be roughly 2.7 times the inflation-adjusted high. Still dramatic, but within the realm of historical precedent when you account for currency debasement. Second, the structural deficit we discussed didn't exist in 1980. Back then, there were massive above-ground silver inventories available. Governments held strategic stockpiles. The Hunt brothers' attempted corner of the market eventually collapsed because supply could meet demand once prices spiked. Today's situation is fundamentally different. There are no government stockpiles to dump on the market. Above-ground inventories have been drawn down for years. The deficit is real and growing. Third, industrial demand in 1980 was a fraction of what it is today. Solar panels didn't exist as a major industry. Electric vehicles were science fiction. The AI revolution and its massive data center requirements were unimaginable. Medical technology was primitive compared to today's silver-dependent devices. The industrial consumption base is orders of magnitude larger now, and it's growing exponentially. This creates a floor under prices that didn't exist in previous decades. Fourth, and perhaps most important, Oliver's momentum analysis isn't based on hope or speculation. It's based on pattern recognition across decades of commodity cycles. He identified copper's massive move before it happened. He caught lead's tripling. His framework works because it measures underlying market forces that eventually express themselves in price. When those forces build to the levels his indicators are showing now in silver, history demonstrates that extreme price movements follow. The question isn't whether it's possible. The question is whether investors will recognize the signal before the move is already well underway. Let me give you some additional context that reinforces Oliver's thesis. Between 2020 and 2024, while most investors were focused on technology stocks and cryptocurrencies, something quietly happened in the silver market. Exchange-traded funds backed by physical silver saw massive inflows. The Reddit-driven silver squeeze attempt in early 2021, while it didn't achieve its stated goals, did reveal something important. There's enormous latent retail demand for silver that can be activated quickly. Industrial users began securing long-term supply contracts at prices well above spot market rates because they understood the deficit dynamics. They weren't willing to risk production disruptions due to metal unavailability. Mining companies, despite higher silver prices, struggled to increase output. Ore grades continued declining. Permitting delays lengthened. Capital costs soared. The supply response that classical economics predicts simply hasn't materialized. Meanwhile, central banks globally continued buying gold at record rates. But that buying didn't extend to silver because silver isn't a monetary reserve asset for governments. This means the entire burden of the supply deficit falls on private market participants. When you combine structural deficit, inability to rapidly expand supply, accelerating industrial demand, and the technical breakout Oliver's indicators are showing, you have the recipe for a price explosion that will shock most market observers. Now, here's where Oliver's timeline becomes critical. He's not saying silver will reach $500 eventually, sometime in the distant future. He's saying the opportunity window for positioning is measured in weeks, and the major price acceleration will occur over the next 4 to 5 months. This summer. Not next year, not in a decade. This summer. Why such a compressed time frame? Because that's how momentum structural breakouts work. The decades of suppression create enormous pent-up energy. When the technical resistance finally breaks, as it has now, the release happens quickly. Think about a dam holding back water for years. Small cracks appear. Pressure builds. Then suddenly, catastrophically, the dam breaks and decades of accumulated water floods through in hours, not years. Oliver's framework suggests we're past the point of the initial crack. The structural break has occurred. What comes next is the flood. For investors, this creates both opportunity and urgency. The opportunity is obvious. If silver moves from $7,700 to even $300, let alone $500, those returns dwarf almost anything else available in traditional markets. A $10,000 investment becomes $40,000 to $65,000, but the urgency is equally important. If Oliver's timeline is correct, waiting to see confirmation means missing the most explosive part of the move. By the time silver is at $150 or $200 and the mainstream media is covering the rally, the easy gains will already be captured. The investors who positioned at $25, $35, or even at current levels around $77 will be the ones who benefit most. Those who wait for certainty will be buying at prices that already reflect the new reality. This is the nature of structural market transformations. They reward early recognition and punish hesitation. The majority of investors will recognize what happened only in hindsight, after the move is largely complete. Let's be clear about risks, because no investment thesis is without them. Silver is volatile. The recent 18% correction in days demonstrates that. Momentum can shift. Government intervention, although unlikely given the industrial importance of silver, remains theoretically possible. Unforeseen technological breakthroughs could reduce industrial silver demand, though no such substitute currently exists for most applications. A severe global recession could temporarily dampen industrial consumption. These risks are real and should be acknowledged. But against them, you must weigh the compelling evidence, the structural deficit that's undeniable, the momentum breakout Oliver's decades of analytical work have identified, the gold-silver ratio dynamics, the industrial demand acceleration, and the supply constraints. For investors who understand precious metals markets, who have studied previous bull cycles, and who recognize the unprecedented nature of current conditions, Oliver's $500 target isn't outlandish. It's the logical mathematical outcome of forces already in motion. The silver market is telling us something profound. After decades of suppression, manipulation allegations, and disappointing performance, the metal is breaking free. The structural foundation is set. The momentum is building. The deficit is real and growing. What happens next will likely be studied by market analysts for decades as one of the great commodity bull markets of the 21st century. The only question is whether you'll be positioned to benefit from it, or whether you'll be reading about it afterward, wishing you had paid attention to the signals. Michael Oliver's track record speaks for itself. His momentum structural analysis identified major moves before they happened throughout his 40-year career. When an analyst with that history issues a $500 silver target with a 4 to 5 month timeline, dismissing it as impossible or unrealistic is the real risk. The evidence is clear. The technical breakout has occurred. The fundamental support, explosive upside. The opportunity window is now. Call to action. The silver market is at a historic inflection point. The question isn't whether you believe a move to $500 is possible. The question is whether you're willing to position yourself before the crowd recognizes what's happening. If this analysis resonates with you, here's what you need to do. First, educate yourself further. Don't take any single analyst's word as gospel, including Michael Oliver's. Research the silver deficit. Study the gold-silver ratio. Understand momentum analysis. Look at historical precious metals bull markets. The more you understand the fundamentals and technicals, the more confident your positioning will be. Second, assess your risk tolerance and investment timeline. Silver's volatility means you need to be prepared for sharp corrections even within a broader bull market. Never invest money you can't afford to lose or that you'll need in the short term. This is a volatile asset class that can test your conviction. Third, consider your position sizing carefully. Even if you're bullish on silver, concentration risk is real. Most financial advisors suggest precious metals should represent 5 to 15% of a diversified portfolio. Determine what percentage makes sense for your situation. Fourth, decide how you want to gain exposure. Physical silver coins and bars offer direct ownership, but come with storage and insurance considerations. Silver ETFs provide liquidity and ease of trading. Mining stocks offer leverage to silver prices, but carry company-specific risks. Futures and options provide maximum leverage, but are suitable only for experienced traders. Fifth, and most importantly, act with urgency, but not panic. If Oliver's timeline is correct, waiting months to make a decision means missing the opportunity. But rushing into positions without understanding what you're buying is equally dangerous. Find the balance between informed urgency and reckless haste. The window is open right now. Silver is still below $80. The mainstream hasn't caught on yet. The momentum breakout is confirmed, but the parabolic phase hasn't begun. In 6 months, you'll look back at this moment as either the time you recognized a generational opportunity or the time you let skepticism and hesitation cost you life-changing returns. The silver market is screaming a message that veteran analysts have been waiting decades to see. The only question is whether you're listening. Don't let this opportunity slip away. Research, understand, position, and prepare for what could be the most dramatic precious metals move of your lifetime. The countdown to $500 silver has begun. Make sure you're on board before the acceleration phase takes prices beyond the reach of latecomers.